So today we want to finish up the other risk and get into the great thinkers in risk management. Last class we were talking about operational risk, and I was showing you an article by Saffo. In that article, what I'm trying to convince students of, and if I can convince you of this, you can really radically change your company, is to rethink the whole concept of forecasting, its whole purpose. The purpose of forecasting is not to predict the future, because we'll never do that. We have no hope of doing that. The world is far too complex. The goal of forecasting in finance and in actual science and decision science, the goal of a forecast is risk management. It is to come up with the distribution, some understanding of our uncertainty, what we do know, what we don't know, what's the range of possibilities, and then to manage our lives, our businesses, based on that uncertainty. So we started off with this in this article. The first thing he says is to find what he calls the cone of uncertainty. What are those things that we know, we don't know, that full range of what could happen? Use 2020 as a good example of this. December 2019, we're coming into a new year. People are talking about the stock market being on its last leg, the economy being close to maybe some type of correction or slowing down. Some rumors, some talk about a pandemic, but we've heard that before with so many other health crises around the world that have been dangerous for certain areas but haven't spread globally. And you have that information, and now you need to set up what is going to happen in 2020. Your cone of uncertainty would have probably been far too tame, would not have been wide enough. And that should be a lesson that we really, even our cone of uncertainty is probably not nearly wide enough. We're probably far more optimistic and far more certain of our understanding of the future. Very few people forecast recessions. That's one of the things, when I used to do forecasting, we were doing a forecast out 7 to 10 years. So I would just ask the question, who thinks we will have a recession sometime in the next 10 years? And almost 100% of the people say yes. And then I say, well, how many recessions are in our forecast? And, well, none. Well, if we all expect a recession, why don't we have a recession? Well, because it's a point forecast, and every year is what we expect. So we don't expect a recession in that particular year, but if we're doing the range, the cone of uncertainty, then every year would have the possibility of a recession. And so that uncertainty would help us understand, how does our business react? If we do decision A, how will that react in a strong economy? How will it react in a weak economy? And we can make much more informed decisions. So the second thing he says, which is a tough one, is to look for the S curve. And one of the biggest things, we'll talk about black swans with Nassim Taleb, but one of the important things is in this world is how pretty unspectacular most things are. And then out of left field, something comes along and changes everything. Some new innovation, some new development that's radically new. And we see them coming, and that's the S curve. The S curve, if you think about it, it kind of is flat for a while, and then suddenly you see this major shoot up. So change starts very slowly, very incrementally. We don't really notice it that much. People start questioning if it's ever going to happen, and suddenly it explodes. There's so many examples of that. I think autonomous vehicles is the one for me. We keep saying it's going to be here, it's going to be here, we're going to have them, and then it doesn't happen. It may never happen, but if it does happen, there's going to be an incredibly fast sea change. You think about when the car first came to the United States, when we started first driving, there was no infrastructure. But how quickly, you go back and look at that history, how quickly, once we started building the interstate highways, how quickly that infrastructure of restaurants and hotels just propped up because the economic forces are there. Same thing with electronic vehicles. As they start, and I think that S curve will probably be much faster than it is for autonomous vehicles, but we'll see. We're usually wrong on how fast the S curve is. But people say, well, we can't do electronic vehicles because we don't have the infrastructure to power them up. But there are some incredible innovations coming in on batteries that charge much faster, And I actually think electronic vehicles and autonomous vehicles can work together such that um, they complement each other. These are things where if you start thinking about infrastructure, once the American public starts shifting, our economy is so rapid, so flexible that the infrastructure is amazing because of the economic incentives comes along. So if you're thinking, well, I just can't see it, well, it's amazing. Things. So that's the problem with the S curve. It just doesn't seem like anything's happening, nothing happening, and suddenly it takes off. You might say the same thing with our artificial intelligence. There's just so many things where it just looks like we kept saying it's coming, and yet we don't see it yet. The art of forecasting is identifying the S curve pattern as it begins before the inflection point, because those inflection points, when they happen, it's too late for you to do anything. We usually miscalculate the speed. There's a tendency to overestimate the short term and underestimate the long term. So usually it takes much longer. Autonomous vehicles is such a great example where we've been hearing from Google and others that, yeah, it's just around the corner, and in 2020 we'll have all these autonomous vehicles everywhere, and then it didn't happen. He says, never mistake a clear vision for a short distance. So we may be sure it's coming. That's somewhat what happened to artificial intelligence. It's like, oh, it's definitely coming, and then nothing for about a decade. And it's like, what happened? Now we're starting to see it coming back again, mainly because of what's going on in China, but it's still not giving us what we thought we would definitely have been seeing 10 years ago. And we're linear thinkers. I think that's a great comment. We're not really good at the sudden exponential growth that happens, even though we've seen it in our lifetimes. The internet is a good example in my lifetime. It's just amazing. I'm on my bike watching videos, listening to recordings and podcasts. There's things that I'm doing today that would have been very difficult for me to explain to my high school self. It's just amazing the things that we're doing. But my high school self might have thought we would have been in flying cars by this time. So the things we're doing would have been just absolutely amazing to my high school self. But there's things we're not doing. My high school self would say, well, why aren't y'all doing this? So it's tough to see out 10, 20 years because the world is changing so rapidly. Even if we notice beginning of change, we tend to draw the straight line, and that's rarely the way it's going to happen. One thing I tell students today that wasn't true when I graduated from college is the importance of which industry you work in. In finance, and obviously in actuarial science, it's a very industry-specific field usually. Most finance people, their expertise, their specialization is in an industry. For me, it was understanding insurance and banking and real estate and pension plans. When I graduated from college, you just picked an industry and learned it. You didn't need to think that much about it. Just pick one. Utilities, telecommunication, technology, retail. Just pick one, learn that industry really well. Today, that's no longer true. Today, you need to think about that industry as long-term as you can, because for the first time in my lifetime, we're talking about entire industries disappearing. What happens to Valero if 100% of the cars purchased 5 years from now, 10 years from now are electronic vehicles? Now that may not be the case, but 20 years from now, definitely. What happens to a UTSA if autonomous vehicles become the norm? You think through each one of these, and we're talking about today with shopping, we're talking about curbside pickup and home delivery. We're looking at stores that have no employees. You just walk in. There's things we're looking at. Which of those might happen? Which of those may not happen? It's difficult to know for sure, but which industry you pick is going to be incredibly important. Or maybe related to that is what skills you obtain. That's why I think decision science is becoming such a dominant field, because decision science can work in any industry. Whereas if you're in finance, you learn an industry and then that expertise becomes your expertise. If that industry disappears, you're somewhat overtrained for something that doesn't exist anymore. So the S-curve is becoming more important and when it comes to picking careers than it has ever been before. Next thing he says is embrace the things that don't fit. And that's one of the things we're going to talk about with Kahneman, is this tendency for these biases, confirmation bias, we tend to get these things set in our minds, and our egos, what our egos do is we look for things that confirm what we already believe, and we quickly discard anything that doesn't fit in with what we already believe. And he's saying do the exact opposite. Look for those things that do not fit with what you believe, because they may be the most important things out there. So the best way for a forecaster to spot the S-curve is become attuned to things that don't fit, things people can't classify or will even reject, because our dislike of uncertainty, our preoccupation with the present, we tend to ignore indicators that don't fit into what is already familiar to, what we already believe. Next thing, I love this, hold strong opinions weekly. And notice that weekly is W-E-A-K-L-E-Y, not W-E-E. Hold strong opinions weekly. And my way of stating this is never invest your ego into your opinions. Give yourself an out. Don't, this is a big deal with finance. I don't think actuaries have this issue. Actuaries, that's one reason, one of the many things I loved about working with actuaries is if the data didn't fit, they were very quick to change and move on to a new area. They had no problem discarding their previous beliefs, and it was very, very refreshing to me. In finance, there's a perception of finance people being these kind of ego-driven, overly confident, somewhat arrogant professionals that, we state our opinion and then we stick with it. You see it with the talking heads on TV, people who really don't have a clue what they're talking about, but they state it with such conviction. I would encourage you, and it's tough in the career because in finance they expect you to be confident, to state your opinion strongly. But I think you're better off if you give yourself an out. When your boss says what's going to happen, you instead of saying your opinion what's going to happen, you instead give a cone of uncertainty. If the Fed does this, then I think this is the most likely, although it could go like this. However, if the Fed doesn't do that, then then your boss can be like, well, tell me what you think. I had a boss like that. Well, tell me, that's why I hired you. I hired you to predict the future. It's like, no, that's not why you hired me. You hired me to predict the distribution of the future and make decisions within that distribution. It's a hard way to think in finance because our incentives, our compensation is based on us being much smarter than we really are, and especially smarter about predicting the future. So he says one of the biggest mistakes a forecaster or any decision can make is to over-rely on one piece of seemingly strong information because it happens to reinforce something you already believe. That's that confirmation bias again. In forecasting, as in navigation, lots of interlocking weak information is vastly more trustworthy than a point or two of strong information. Once researchers have gone through a long process of developing a beautiful hypothesis, boy, they're not going to let go of it. They're so invested in that. I'm going to talk about later how you can find people you can trust and listen to, knowing that this is the type of bias we have. Good forecasting is the reverse. It is a process of strong opinions, weakly held. If you must forecast, then forecast often, and first actually seek out to prove yourself wrong. That's another thing you can do when you're talking to your boss. I really think this is what's going to happen. However, I'm going to be watching next week because if I see this, I'm going to discard this view very quickly. Set up your escape hatch when you're telling your boss what you think is going to happen. Having strong opinions gives you the capacity to reach conclusions quickly, but holding them weakly allows you to discard them the moment you encounter conflicting information. The time period, he says, we tend to be far too preoccupied with the recent past. And he says we need to look back much further than we do. Used properly, our historical rearview mirror is an extraordinarily powerful forecasting tool if we look back far enough. Or we are in a moment when the old mass media order is being replaced with new personal media, and it's not just traditional media players who are struggling to adjust. Cutting-edge players on the information revolution are peddling even a bit hard. This seems awfully current, but this article is a few years old. The recent past is rarely a reliable indicator of the future, so always look back twice as far as you're looking forward. The hardest part of looking back is to know when history doesn't fit. the temptation, and this is kind of a nice little funny quote here, temptation is to use history, as an old analogy goes, the way a drunk uses a lamppost for support rather than illumination. So, I talked about how I use historical VAR to support my views because it works so well, but that's because my audience relied on historical VAR. I knew deep down the history I was looking at supported my view because that was a particular point of history that really supported my view. So I try to be as honest, and I told the people I was presenting that. But you don't want to look for history to support what you believe. You actually want to look for history that disproves what you believe. Find periods of history. That's one thing we talk about when we're trying to come up with an investment strategy, is to look for out-of-sample data. So don't overfit your data by using every single point of history you can. Test your data in different historical periods. Test your data in different countries. Maybe your strategy works really well with small cap US stocks, but it doesn't work with small cap European stocks. Why is that? Is it because there's something different about the two environments? Or is it that it worked in US because of pure, just coincidental, just pure random chance? That there was really nothing there, it just happened to work in that time period that you looked at. I get back to what the gentleman who wrote Random Walk, I can never pronounce his last name, so the guy who wrote Random Walk Down Wall Street, he was making those strong comments about diversification, investing overseas, that really only worked in the time period he was looking at least, it hasn't worked since. And then are there times you shouldn't forecast? Even periods of dramatic, rapid transformation, there are vastly more elements that do not change than new things that emerge against this backdrop. It is important to note there are moments when forecasting is comparatively easy and moments where it's impossible. I don't know when it's easy, but comparatively easy. There are thus moments of unprecedented uncertainty when the cone broadens to a point in which the forecaster would demur and refrain from forecasts. So let's say you're looking February, early March of 2020, and you need to make a forecast. COVID-19's coming. When it first hit, stock markets dropped dramatically. Interest rates just fell like a brick. Incredible uncertainty. What does it mean to shut down an economy, not just in the US, but around the entire world? What does it mean to lock down the entire world? What are numbers going to do? What are consumers going to do? What about industries like travel and leisure? What are they going to, it was an amazing thing. We had no toilet paper, no water, eggs, milk, things were just sold out. The producers of those things, their supply chains could just not keep up. It was amazing. Suddenly, overnight, a huge percentage of the world was working from home. Just before that, just a few months before that, there was a big debate about work from home. In some countries, like the UK, work from home had a negative connotation to people who work from home. Oh, those were the lazy ones who really didn't want to work. They just wanted to goof off at home. And then all of a sudden, people are used to working from home. It's becoming the norm. Will we ever go back to working from offices the way we do now? So we were at a point where it's like, how do you forecast in the middle of this noise? And that's the point where you might say, hey, let's step back and see what happens. Make sure we're doing what we need to be doing. But it may not make sense to do a forecast in the middle of something like that. And then don't take your forecast too seriously. And my biggest thing is don't invest your ego into your forecast. The next article, I really, really like this article. I'm not going to go through it. I just want to give you what's here. I'm a big fan of Kahneman. We will talk about him more. I don't know these other two writers, and they probably wrote the entire article, and Kahneman just edited and looked at it and put his name on there. But we're going to get much more into this when we talk about Annie Duke and what she has to say about decision making. So a lot of this fits in. You got an exam question on the second exam talking about how we use these great thinkers, their ideas to make better decisions. And so there's a lot of relationship. When we look at Annie Duke, she references Kahneman quite frequently in her book. But we have these biases, and what Kahneman is saying here is not only do we have biases, we're becoming aware of them. We can see them, we can demonstrate that they exist. But Kahneman says, even when you are aware of your biases, awareness of the effects of the biases has done little to improve the quality of business decisions at the individual or organizational level. So even being aware of our biases, we still make bad decisions because of our biases. The same biases that we're aware of, we know they're there, we still make mistakes because of those biases. So the purpose of this article, and again, I won't go through it, I just want to let you know that it's there, because I think if you get some time to go out and read it, or even just read the highlights maybe, it's a powerful concept that he says, while we are almost destined for making bad decisions, there are things we can do to counteract these biases. And Annie Duke has some very similar recommendations as well, so that's why I'm not going to go through the article. So you can read through it, but essentially what he does is he has a list of questions that you can ask. He has questions that the decision makers should ask themselves. So let's say you're the manager and you have a team that's coming to you with a recommendation. Before your team comes in, you need to ask certain questions of yourself. Then you want to ask questions of the team making recommendations to check their biases and get them thinking about their biases. And he's got several of those questions. Then you want a question focused on evaluating the proposal. And he has the biases there. And he goes through each one of those. You can look at these biases, they're really interesting. So if you go through all of this, what you're trying to do, and what he says is the importance for get around, or they say, the three authors here, is the importance here is the individual cannot overcome the biases, the group cannot overcome the biases. But if you interact between the individual and the group, and you use them one off against each other, there are ways not to completely combat the biases, but to get much better about making better decisions, so that you don't become a slave to these biases. So anyway, I'll let you read through those. Good article, really interesting article. And this is a big part of risk management. It is acknowledging we have problems with decision making. We're not good risk managers. We're not good forecasters. We're not good decision makers. And we know why. And there's very little anyone's doing about it, because it's so much part of human nature. But to make us more aware of it, that's why I say change the whole idea of forecasting. Why do we keep forecasting when we know it doesn't work, it adds no value, it doesn't do anything? If more and more of us will start asking that question, USAA spent millions of dollars coming up with these point forecasts, and I'm just absolutely convinced they were of no value whatsoever. There was no decisions made off of them. There was no decisions that could be made off of them, because no one knew if they were any good. No one ever went back to see if they were any good. So to change the whole idea of why we're doing certain things, and to refocus our attention on risk management, on uncertainty, on laying out how uncertain we are, and making decisions within a cone of uncertainty, instead of trying to make decisions as if we know the future better than we really do. Finishing up the this last section, and there's a lot in this section. Obviously, when you're talking about operational risk, it just covers everything. So it's a longer discussion. We obviously could go much longer in this. A few other quotes, and we'll get into this, especially as we get into Doug Hubbard. He talks about this idea of forecasting. That a lot of people, Saffo's last area there is when you shouldn't forecast. Hubbard might disagree with him a little bit on that. What Hubbard has heard is people say, well, we can't forecast, we can't do a distribution on that because we're too uncertain. And he says, well, why leave something out if you're uncertain? If you're uncertain, that's the whole reason for doing an analysis, is to build that uncertainty into the system. Deal with it. Now, I don't know what he would say about February of 2020, because, boy, you're talking about such a wide uncertainty. But he's saying in general, don't leave out a variable because it's too uncertain. That makes about as much sense as not drinking because we are too thirsty. It's uncertainty that's the whole reason why we're doing this. So if we're really uncertain, that's probably the most important factor. And to leave it out because we're uncertain about it is doing the opposite of what we should do. We'll talk about the pre-mortem analysis. You've probably heard that before, but and there's some of that in what Kahneman's talking about, is before the project is approved, actually go with the team and say, okay, we approved this project, we implemented it, and 3 years later we're sitting here talking about it failed. Tell me why it failed, what went wrong. We'll see some of that with Annie Duke as well. The importance of using prediction markets. This has become these binomial prediction markets. I love watching them. They're very interesting in sports. I love looking at them during a football game and seeing how it changes. They put it on the football games. They say the probability this team will win. I actually don't think that's what that is, because a team's up by 14. They say probably it's going to win is 98% or 90%. I don't think the probability that the team wins is 90%. I think 90% of the people betting think that team will win. But if you were asked those people the probability of the team winning, they might say 65, 70%. So it's really important to know exactly what prediction markets are predicting. That's why I heavily recommend that book, Super Forecasters. It goes through some of these prediction markets and who the best forecasters are and why. What are their characteristics? You really need to read that book. What are the good characteristics of good forecasters? And they're not good core forecasters because it gets things right. They're good forecasters because they understand their ignorance. They understand what they don't know, and they forecast in a much more honest way of coming from it that, I really don't know what's going on here. Here's what I do know, and they're much better forecasters. And if you can get yourself to be like that super forecaster, you will be a much better finance professional, much better actual science professional. So you look at their bets, and we've discovered one thing that's really good about prediction markets is that people betting have skin in the game. There's money on the line, and we discovered when there's money on the line that the predictions, the forecast, we're talking about the range again, the cone, the uncertainty is much more accurate when there's money on the line. That's why economists, I think, are such terrible forecasters. First of all, they don't want to be unusual. They don't want to be out of line, so they'll forecast something close to what's just happened. But secondly, they don't bear much pain if they're wrong. They can provide really bad forecasts 100 times in a row, and no one notices. No one really cares. But in prediction market, if you participate and you're bad at forecasting, you will lose money. So you should go out and look at some of these. They're very interesting sites. Just do binomial options. Option markets, they're out there. They're very, very interesting. I'm not encouraging you to go out and start gambling, but they're very, very interesting. I don't know, it'd be nice if they had investment brokerage firms have paper trading platforms that you can go and participate with play money. I don't know if these prediction markets do that, but that would be an interesting thing to do, to give you a chance to just see your power in forecasting. How good are you at forecasting? What are your biases? Try to understand yourself early in your career. And then we need good statistics to prioritize which risks to address first, where to spend most of our money. So there's a TED Talk, a very, very unpopular TED Talk. I think this guy almost got kicked out of the room. There's a podcast of him. Here's the TED Talk, but there's a podcast of him as well on Econ Talk. The Econ Talk was interesting because the gentleman who runs Econ Talk asks really tough questions. He's a really tough interviewer. And so in hearing the two of them debate back and forth on this, but in this TED Talk, he was talking about global warming. And he says, okay, global warming exists. It's going to cause losses. So what should we do about it? And so he goes through the statistics that he has, whether you believe his statistics or not. He has a website, which is a really interesting website, where they're talking about all the risk around the world, And what should we work on first? Should we work on global warming first, or should we tackle malaria? Should we tackle AIDS? Should we tackle poverty, water shortage? What should we tackle? And there's some obvious things that he says sees in his data, like one of the highest causes of death around the world is auto accidents, because a lot of roads, a lot of streets don't have curbs. He says you spend some money there, you impact far more lives doing that than you doing other things. So I'm not saying you have to agree with him, but what I'm focusing on is his approach. Let's look at the data. Let's get away from the hype and let's look at the data. So one thing he mentions, and again, I don't know his data on this, so it's the thought process than the actual data. But some people on global warming say there's a scenario where the whole world comes to an end. And he says, yes, there is a scenario like that, but its probability of happening is, in his opinion, based on the data he has, is a lower probability than a huge rock asteroid hitting the Earth and destroying the Earth. There's a slightly higher probability the Earth gets destroyed by an asteroid than there is that the Earth completely gets destroyed by global warming. So there is a scenario, and some people will say that it's possible global warming completely ends our existence on Earth, therefore we suspend all our resources on it. He says, yeah, but there's other scenarios. An asteroid, there's scenarios about the sun and the thing it's doing with the sunspots, and others. Volcanoes, a volcano explosion that could cause a nuclear winter. There's other things. What are these probabilities? What should we focus on? So whether you agree with his stats or not, the key is let's lay it out all on the table. Let's look at the data, and then I'm going to talk a little bit later about ask who's talking. Who is this guy and what are his incentives? And I think that's a huge one. We'll get into that after we talk about Annie Duke, and as far as to whom do you listen. There are certain people I completely ignore because I know they have a strong, especially on the political side, they have a strong incentive for what they're talking about to be right. So their goal isn't to be right, their goal is for their ideas to not be contradicted, because that's their incentive. That's where they make money, that's how they get elected. So we'll talk about that a little later. All right, that's it for there's so much more we can do there, and we'll essentially be talking about that more as we get into these great thinkers. All right, real quickly, a couple of final ones. Purchasing power risk. That's the risk of loss because of inflation. Obviously, this is the one people are talking a lot about today, because we've got this $1.9 trillion stimulus package coming in right at a time where it looks like the economy is coming back. We're seeing some inflation. We're definitely going to see inflation this year, most people think, because energy prices are up so much. So just the headline inflation numbers are going to be a little bit scary. How do you handle that? Well, inflation works pretty well in a value at risk type of analysis. You can model it. You do have to be careful with inflation. Inflation is not a random walk. Inflation has a lot of serial correlation. It doesn't skip like the stock market does, or other types of prices. So inflation tends to be kind of a momentum kind of thing. It slowly starts taking off. So you have to model it correctly. I had to model inflation for one project I had, and I had to bring that serial correlation in, and it's possible. You can set it up and make it work pretty well. And then what do? You model your income, your expenses, your assets, your liabilities, and you just look and see what will inflation do to our financials. So you think about the pension plan. It's an interesting scenario. If inflation rises, you have to pay out more to your beneficiaries, but interest rates will rise as well. So you have a higher discount rate, but you also have a higher cash flow. You'd have to test those two and see which is dominating, and how to exactly structure that duration of your assets to try to manage that risk. So some assets do better in inflation than others. Obviously, gold's the obvious one. It's negatively correlated to the US dollar. It's positively correlated to inflation. So that's a big one. We talked about that earlier when we talked about the environmental aspect of correlation. Commodities will tend to do well in inflationary periods. Real estate tends to have an inflation hedge. And real estate investment trusts are high-yielding stocks. So people who say, well, I can't buy real estate, but I can buy real estate investment trusts, and I'll use that to protect me from inflation, they may be very, very shocked. USAA, after I left the 401k part of that business, they added an inflation strategy to their 401k plan, and I looked at it, and it was heavily allocated to real estate investment trusts. And I just asked the guy, why do you think those are going to protect you from inflation? Because if inflation shoots up, interest rates will shoot up, and real estate investment trusts, just like utility stocks, the higher dividend yielding stocks, they look like bonds. And when interest rates and inflation shoot up, they tend to fall in price. So I told him, man, it sounds kind of scary, because if people are investing in this because right now because they're worried about inflation, and inflation jumps up, and so they see their portfolio fall 20-30%, they may be kind of upset at you. So it's a tough one, I think. And real estate itself is, we don't price real estate every single day, so it's hard to say exactly what it's going to do. But over the long term, yeah, real estate should do a better job of keeping up with inflation than other things. Cash and short-term savings accounts, they're probably good with unexpected inflation, because short-term rates will shoot up in an inflationary period because of what the Fed's doing. Over the long term, they tend not to keep up with inflation. Obviously, inflation-linked bonds will do well, but they've had negative yields for quite some time. So if you buy them, you're essentially locking in a negative real return. So there are real return funds out there. That sounds great. PIMCO has a real return fund. Their performance has been really bad historically. Essentially what they're trying to do is either give you inflation plus 4% or give you T-bill rates plus 5%, something like that, so that it's just a return that keeps up. So if T-bill rates go up and down with inflation, then you have something that's T-bills plus 5%, but they just have not performed well at all. Derivatives, there are inflation swaps, there are inflation derivatives, but they tend to be fairly thinly traded. I read a great book on how these new derivatives are created, and you really need hedgers on both sides of the transaction, or they just don't work very well. If you have hedgers on one side and speculators on the other side, it just doesn't work well. And there are a lot of people worried about inflation rising. There are not as many people out there worried about inflation falling. So, maybe governments, because they index their tax rates, maybe high inflation helps them somewhat, but they have expenses that go up with inflation as well. So it's hard to find people that are like really worried inflation is going to fall. And so it's just hard to get both sides. But there are those transactions out there. I haven't really looked at them since I was at USA, because we found them interesting. We had a presentation on them, thought they're really interesting. But when they told us the volume that they could support, it's like that's not even a fraction of what we need by ourselves, much less that being the entire market. Currencies could help you hedge, and we'll talk about currency risk. If the US dollar is weakening because of inflation in US, then certainly having other currencies can help you. The challenge you're going to have is if inflation's taken off around the entire world, then your currency allocation won't help you with that. You can hire a currency overlay manager. You can look that up. You can Google that, currency overlay manager. It's someone who just essentially just decides what currency exposure you want. Usually currency overlay managers have economic training. They look at inflation, they look at central banks, they look at what's going on with economies, and they're trying to find which currencies are overvalued, undervalued. If they know what they're doing and they're really focused on inflation, it's possible that they can really help protect you from inflation, but you're very much relying on their skill to understand currency moves. And my experience with them is they're good, but they're not perfect. And boy, there's a lot of noise, what we call basis risk. There's a lot of basis risk there. And that brings up the currency risk, probably my least favorite risk of all. I don't like currencies. My mind doesn't think currencies very well. I was responsible for USA's currency risk. And boy, good thing for Excel, so I could set it up in Excel, because I had to stop and think about it every time. But Excel helped me keep everything in line. My brain, because I've only lived in the United States, only used the US dollar, I've gotten a little better when I go to Costa Rica, converting between the colones and the U.S. dollar, but it's tough for me because I'm just not used to it. And plus, currencies are quoted so differently around the world between the yen and the pound and the euro. It's just my brain just has a tough time dealing with it. So currency risk, it's a risk that you have exposure to different currencies, and the currencies change in a way that you have different experiences with your revenues versus your expenses, with your assets versus your liabilities. Now, if you took an accounting class that talked about translation accounting and currency accounting, it's an incredibly complex part of accounting, but it's not very economic. And that was our challenge at UTSA, is I had our currencies matched as well as we possibly could. And yet we kept showing currency losses on the financials, and unfortunately, I don't know whose idea it was, but the currency loss was minuscule at UTSA. It was a few $100,000, but for some reasons the accountants had it on its own separate line on the financials. So our CEO kept seeing it. Anytime he saw a negative number, he would come chew me out, and boy, he beat me up about this. But no one could explain to me the currency accounting. It was definitely not economic. When they told me they had gains and losses on the currencies, we really didn't. What they were saying was a gain and loss was offset by gains and losses in the financials that were not shown as currency gains and losses. So you can't rely on the accounting. So here's an area where a great hedge economics may not reflect in the accounting, and it creates a lot of confusion. It's really quite frustrating. So how do you measure it? Value at risk is the best way to do. But again, with value at risk, you may have to model the accounting side and the economic side, and the accounting side is incredibly difficult. That was my frustration. I talked about at UTSA, we had a new accountant that knew derivatives accounting. Boy, that was so helpful to me. But because currency was such a small risk at UTSA, we had a European office and a UK office, and we did business with our customers overseas in pounds and in euros. But it was a small part of our business, a few $100 million business, so really small for a multi-billion-dollar company. But it was there. There was some currency risk. But because it's so small, the accountants, we did not have an expert on currency accounting. And so it did whatever it did, and the accountants just kind of, whatever it did, they accepted it. And no one there could explain to me what the accounting was doing, and no one really wanted to spend the time on it because it was so small. So it was frustrating. The CEO seemed to be the only one who cared about it. I really wish if they had put that line and just, like they did with other miscellaneous lines, just plugged it into an other line and not had it been its own separate line, the issue would have never come up. How do you mitigate it? Well, there's definitely a lot of derivatives, and they do an exceptional job. Currency futures and swaps are a huge market. So you can mitigate it. Just be aware that the economics don't match the accounting. So that's going to be the most challenging thing. The way we did it at UTSA, actually, one of the most humorous presentations ever made. But the investment team at UTSA called me and said, "Ron, we're managing this portfolio for our German and UK offices, but we don't have time to mess with it. It's not a market we know. It's not open when we're at work." And so what I did is I recommended that we hire managers. We hire a portfolio manager in Europe to manage both our European bonds and our European currencies. I remember taking that to the exec council, made my presentation. At the end of it, the CEO, who was usually not in the mood to approve anything he didn't understand, but at the very end of it, he said, "Does anyone know what Ron's talking about?" The whole room said no. And he says, "Anyone have any reason not to approve what he's talking about?" And the whole room said no, so they approved it. And that was just really bizarre, but we got it approved. The investment team was really happy to get that off their plate. And again, by European offices, their own portfolio managers. And so we managed. What I would do is I would go to the portfolio manager in Europe, say, "These are the currency exposures we need," and they would line those up. We had to look at the regulations because UK regulations would not allow me to hedge out our exposure to pounds. We had to do everything from a UK perspective. but I was wanting to do it from a U.S. perspective, and so I had to manage that risk. So it was complicated for something so small. It was quite complex. I have no idea what they're doing today. They're probably just ignoring it today because it's they have two new CEOs since that time, three CEOs since that time, and it's a very small risk. Major entities like Coca-Cola or any major IBM, Exxon, currency risk is a huge risk, and there's a whole team that probably manages that. All right, so we've gotten through all of the universal risk. On the exam, what you'll see the question on the exam is you'll go back all this stuff we just talked about, and I'm going to let you pick one major risk and two smaller risks and just tell me everything you know. So hopefully you've been paying attention, taking good notes. Now I want to go through who are the leading writers and thinkers on risk management. And I've got my four favorites. I might be adding to this list. I'm constantly looking for new writers on this. But these are my four favorites. These are the ones I really love what they have to say, and they have had humongous influence on what's going on in risk management. They're also good writers for you to read that will help you tremendously in interviews because they are talking about the stuff that companies are talking about. So, I remember in my first interview, I have no idea why they hired me because, boy, I didn't have a clue what I was talking about. But at the end of the interview, they ask, what's an important thing that you think we should be talking about, or what concerns you, or what do you think is the most important thing going on right now? If I were to get that question today, I would be giving them a risk management answer related to what these authors are saying. And I think it would be a really powerfully strong answer. So we're going to do Taleb, Kahneman, Duke, and Hubbard. Hubbard might be my favorite just because I think he's the most practical at all. Annie Duke is really practical. I think she's most practical more on the individual level, while Hubbard's much more practical at the corporate level, making decisions for companies, but very strong. Taleb and Kahneman essentially set up the problem. What's wrong with our decision making? What are we doing wrong? What's harming us? What's causing us to make bad decisions? Annie Duke and Deb Hubbard is, that's all true. Here's what you do to fix it. This is how you can practically get better at becoming a decision maker. So Taleb is a famous article he wrote. Black Swan, Fooled by Randomness, Anti-Fragile, The Bed of Procrustes. To me, the Fooled by Randomness I found the most interesting. Black Swan's the most famous. He says Anti-Fragile was the most important book that he wrote. I was not a big fan of Anti-Fragile because I felt he went a little overboard in his examples and got a little tedious to hear about his exercise routine and eating habits. So it was a little tiresome in places, but he had what he says there I think is really important. We'll see his main point there. You can summarize his main point very quickly. This last one is I don't know, a book that he wrote just to get a few random thoughts out that he hadn't made in the other books. So I definitely recommend you read the first two. Anti-Fragile, yeah, you probably should read it because I think it's an important concept, but you might not enjoy it as much. You can let me know. So what I'm going to do is I'm going to go through quotes from these books. I've got the quotes down here. I have them highlighted. The blue highlight are his main points. So you can see as we go through blue, I'm going to give you his main points. So I'm going to try to take 4 books and summarize it in just a few pages of notes. So on the exam, I forget exactly how I've written, but on the exam you'll be picking 1 or 2 of these writers, and you're going to summarize what we've learned, what these writers have to say about risks. So as I go through this, you need to be taking notes, maybe doing some Google searches outside, some things you can do to enhance your answer. But take notes, write things down, think about what we're saying throughout this so that you can do well, not just on the exam, but remember this for interview questions because I think these are really powerful concepts. So here we go with Taleb. We'll see how far we get today. But the first thing he says is we far over-rely on the normal distribution. We saw that when we were doing the risk management project, looking at the difference between parametric VAR and historical VAR. And we could see in the example I showed you how very different the answers were. We had that portfolio we said was going to have the same level of risk with higher return. And then we looked at history, and the history was actually a lower return but lower risk. But the world itself is the world normally distributed. And Taleb has these two words that he's made up. You can see Bill Gates doesn't think they're words, but mediocristan and extremistan. And he says normal distributions work really well in mediocristan, but do not, they're actually dangerous and actually lead to bad decisions in extremistan. So what is mediocristan? Mediocristan is kind of the natural world. It might be, I always give the example of the average, the heights of people. So if you try and get the heights of U.S. men over the age of 20, you could do a sample of, say, 2,000 people of all different ages and from all over the country, and you would probably be really good. Your distribution would probably reflect very, very closely the overall population. And once you looked at those 2,000 men and put their heights in, you'd probably come to the conclusion that the probability of an 8-foot tall man, or a probability of 18-foot tall man is 0. The probability of a 2-inch tall man is probably 0. You'd be pretty confident that's the case. You wouldn't say, well, you know, there could be an 18-foot man out there somewhere. Your data will give you pretty good confidence that that would not be the case whatsoever. So mediocristan does work with certain things. Works really well in insurance when we're looking at mortality, when are people going to die, looking at health risk, looking at auto accidents, home insurance. It works really, really well. There are a few places like with flood and earthquakes and hurricanes where there's some extreme events, but even then we've got some pretty good data that, you know, what's the probability? I was talking to my insurance class, you know, why don't get hurricane 7 is, you know, on the scale of 7 or 8? Why do they only go up to 5? And the physics show that once a hurricane gets up to 4 or 5 in strength, they destroy themselves. They make the water so cold that they destroy their own generator of power. And so there are natural limits that just keep things. You know, there's natural limits that keep us from having 18-foot tall men. It just isn't going to happen. It's just impossible. In extremistan, that's not the case. So the best example in extremistan is wealth. If you go out and look at 2,000 men or 2,000 households and you get their wealth and you do a distribution, you'll come to the conclusion that there is no one anywhere in the world worth more than $100 million. You would say that's absolutely impossible. Until, you know, Bill Gates or Warren Buffett or even Red McCombs, until one of those people come into your distribution, you're going to say it's impossible for them to exist. And in that case, how large of a sample size do you need? You need a sample size until you get a billionaire. Until then, your sample size is not large enough. And how many people do you need? You might go 1 million, 2 million people before you get a billionaire in there. And so until you get that, or even someone with over $100 million, until you get there, you're going to say it's impossible for someone to have that much money. And so extremistan, those type of distributions, sample size is almost impossible to come up with. We do not know what the right sample size is for those type of distributions. So for extremistan, history tells us what has happened, does not tell us what could happen. And mediocristan, history tells us what has happened and what will happen. Mediocristan says there have never been any 18-foot tall men, and it also will tell us, history also tells us there never will be. And we can have pretty good confidence with that. Sometimes a lot of data can be meaningless. At other times, one single piece of information can be very, very meaningful. That's what he's talking about in extremistan. In fact, more data can actually be dangerous because it gives us more confidence that something cannot happen. You look at the last 50 years of the U.S. stock market, and your worst years may be down 40%. And you say, there's no way the U.S. stock market can fall 70%. Why? Because it hasn't done it before. He gives some really funny examples of that. In one, he says he can prove that George W. Bush is immortal, and his proof for that is that he's seen George W. Bush alive for thousands of days in a row, and he's never died once. Therefore, he must be immortal. He gives the turkey example of these turkeys that they get fed every day, and they're thinking, wow, this is a really good life. Let me predict my life. And they keep getting fed. And in 1 year, around July, August, they're fed extremely well, and they're thinking, wow, that must mean, our distribution, historical distribution means, wow, we've got a great life ahead. Well, then Thanksgiving comes, and they discover that history was actually more dangerous than helpful. The fact that their feeding was going up suddenly was actually an indication that the end was near, not that their future was getting better. Fragility and vulnerability is the estimation of tail events. The odds of a 4 sigma event is more than twice that of a 4.15. That's one thing in that normal table. When you get out to the tails, small changes in the sigma have huge implications for probabilities, and that probably are not true for the distributions we're looking at. The odds of a 20 sigma are 1 trillion times higher than a 21 sigma. If you actually do the math, they don't look that much different, but we say, wow, that's absolutely impossible. And yet we saw some 10, 15 sigma events in the data for the S&P 500. So small measurement errors on the sigma will cause massive underestimation of probabilities. That's the problem with these distributions, is they say these tail events can never happen, and that's true if the normal distribution is correct. But for a lot of the world we're looking at, that is not correct. And the stock market is a good example. The U.S. stock market, it's almost normally distributed. It comes really, really close. It's just that the tails, especially on the downside, the tail is slightly fatter than a normal distribution. But that slightly fatter has, when you're out in the tail, slightly is a massive difference. It's not a small difference. The entire statistical business confused absence of proof with proof of absence. It's never happened, therefore it can never happen. That is bad risk management. So the normal curve, this allows large deviations. Remember, the reason I don't like value at risk is value at risk says name your risk tolerance, and anything happens less frequently than that, ignore it. And what Taleb is saying is, no, it's those rare, huge events that you should be focused on. That's the most important thing. The correlation measures will be likely to exhibit severe instability. We've already seen that, right? It will depend on the period for which it was computed. We've already seen that. That was my complaint with the gentleman who did Random Walk Down Wall Street. Yet people talk about correlation as if it were something real. This sounds very much like we saw from the Bridgewater people. Once you get a bell curve in your head, it's hard to get it out. So he does not like normal distributions for the type of things we do in finance. And I agree with him there, although we use it. I use it in my career quite a bit. It's hard not to, because it sure makes life a lot easier. Finance gets paid for luck. There's so many stories of people who have made a lot of money in finance, not because they were smart and had good ideas, but because they just happened to be lucky early in their career. Now, Warren Buffett, I think, is a really brilliant man, smart man. But is he famous and wealthy today because of how smart he is, or is he wealthy because he had some lucky trades early in his life? If you read some of the famous people in finance and go back, there's some great books that go back through some of these people's lives, and you get the impression reading their lives that there was a huge amount of sheer luck that got them to where they are. There was definitely skill, intelligence going on, but it took that luck, some huge black swan events that got them where they are, that if they had not happened, we would probably have no idea who they are today. They might be doing well and have a good career, but they would not be, worth $50 billion and famous. So we perform well, often entirely due to luck, but force our clients to pay up for that luck. He uses the Russian roulette example, and I've used that in my class. I think it's an interesting one. Essentially we have this gun with maybe 100 cycles to it, and we have 1 or 2 bullets in it, and we point at our customer and pull the trigger, and no bullet comes out, and we say, hey, look, we did a good job and they pay us. We point it at them again and pull the trigger, and again nothing happens. They pay us again. Would you play Russian roulette with a gun that had 100 barrels to it? Probably not. If it had 1 or 2 bullets in it, probably not. It's back to my concept of the heat maps of a low probability event. If I'm doing skydiving, 1% is too high of a frequency. But we do that, and then eventually what happens? Every time we pull the trigger, what's happening? Well, our customer is happy and they pay us more, but the risk is actually going up. The probability the next time is a bullet is going to be higher. And so, yeah, it's dangerous what we do, but we get paid for essentially rolling the dice or spinning the pistol. We move from an ownership society to an agency society, and that's part of it, the skin in the game. Our skin in the game is to keep getting paid. It's that career risk. We're managing our career risk. We're not managing our client's risk. We have stopped managing money. We've become marketers of random outcomes. That's a great quote. Professor Sweet agrees. I agree. He believes we add value in finance through risk management and asset liability management. We do not add risk through trying to beat the market. Remember, my recommendation on balance sheet immunization on the pension plan was ignore alpha risk, ignore asset risk. It's already in your asset liability management. Focus on risk management. Focus on ALM. The reference point argument is as follows. Do not compute odds from the vantage point of the winning gambler. Look at it from everybody who started off. There's some books out there that talk about the habits of successful CEOs. What they don't mention is that the habits of unsuccessful CEOs were exactly the same as the habits of the successful CEOs. But since the book went out and looked for successful CEOs and asked them what did you do, they got those habits. What they didn't do is go out and find unsuccessful CEOs and ask what their habits were. They would have discovered they had the exact same habits. At any point in time, the richest traders are also often the worst traders. The most successful traders are likely those that are best fit for the latest cycle. That when you go back to the Metacreston world, like dentists or pianists, you don't see that. You don't have dentists that are suddenly really good for 6 months and then they start killing people. You know, if someone sat down at the piano and perfectly played a Beethoven sonata, it's unlikely that was due to random chance. I mean, it's possible, right? If 1 trillion monkeys sit down at a piano, one of them will eventually play a Beethoven sonata. But if you see a monkey play a Beethoven sonata, you're probably not going to say, oh, that was that 1 in 300 trillion. You'd probably say, wow, what's with that monkey? That's pretty impressive. So, yeah, in the Metacreston world, we don't see that type of incredible luck leading these big gains, but we do see it in finance, and then once we see it, we say they're geniuses. We pay them a big raise. He talks about, you know, this you can read through this quote on your own, but, you know, just from random chance, if all we did was flip coins, you would have great managers at the end, and they'd be writing books about what a good money manager they are, even though, you know, this is in the world of just pure random chance. What we see in the world of pure random chance is exactly what we see in the world where we don't think there's random chance, where we say there's skill. There's no difference in those two worlds. In the investment world, those managers you say they're so good and we really build them up, those number of managers are exactly the same number of managers that you would see if everything's random. So, yeah, it's sad. We don't want to admit it because we all want to talk about how skillful we are and how much value we're adding, but it's just the truth. There's so much luck. Should he stop? So what happens if we're rolling dice and finally one of them doesn't, or flipping coins, whatever, and one of them doesn't roll the right side? Then he's going to start writing. We'll start writing articles about how he lost his skill. He ran out of luck. We've seen several articles of that about Warren Buffett. Warren Buffett goes from being the greatest in the world to being out of step and lost his touch. We just see go back and forth. There seems to be no such thing as a foolish decision if it results in profits. We're going to definitely get into this with Annie Duke. This is one of her biggest points, something she calls resulting. The link between skill of the CEO and the results of the company are tenuous. All right, so we'll start on this one in the next video. You can see I'm a big fan of his points. One thing I would recommend that you do if you have some time is there is a great YouTube out there where Kahneman is interviewing Taleb. Taleb doesn't do too well in that interview. Kahneman really dominates that one, but it's a very interesting discussion, and Taleb does have a few good points. Kahneman really shows that what Taleb's saying makes a lot of sense, but there's a lot of kind of gray area around what Taleb's arguments. So it'll help you after you see this to go and see that there's more to it, and it's really quite controversial and quite complex.